Good afternoon, everyone. Thank you for staying. We have saved the best for last. So I have the great pleasure of introducing our speaker, Beatrice Weder di Mauro, sitting over here. Beatrice is a highly accomplished, highly influential economist with research interests in international macroeconomics, financial crises, and climate finance. She is president of the Center for Economic Policy Research, widely known as CEPR. She is professor of international economics at the Geneva Graduate Institute and a distinguished fellow at INSEAD. From 2004 to 2012, she served on the German Council of Economic Experts, a very important institution in Germany. She has extensive experience as an independent director on the boards of global companies, including Bosch, Roche, and UBS. So I could go on, but we want to hear from Beatrice. So in her remarks today, she's going to distill some important lessons for us from the first failure of a global, systemically important bank, I guess, after Lehman Brothers, and otherwise known as Credit Suisse. So Beatrice, please join me.
Thank you, Steve. Thank you to the organizers for having me. It is always a huge pleasure to be back in Singapore. And by inviting me to write up this policy note, you have also forced me, or since I accepted it, forced myself to come up with what where I now stand, what I think are the most important lessons from this big crisis that we had. So, there is this saying, never waste a good crisis, and certainly from the Swiss point of view, Credit Suisse was a good crisis. It was a big crisis. It was a shock. But it was also a shock to markets because at the end of the day, it had not really been expected that over that weekend, it would really be the end of Credit Suisse. And it was a shock to the international community of regulators who had been busy for 15 years in crafting a big architecture called the Too Big to Fail framework. And so it posed very deep questions about whether the framework had failed or whether only an institution had failed and the framework was absolutely sound. So that's the point I am going to be focusing on. Are we still facing the problem of too big to fail? And what can we learn concretely from the way that Credit Suisse failed? So this is the outline. I will first take a step back and review very briefly and very selectively the lessons that were drawn 15 years ago from the big global financial crisis and what was built based on those lessons. Then I will review the case of Credit Suisse and go into a few, again, highlighting a few of the features that Credit Suisse had and which were important in understanding what happened. And finally, I want to focus on two things that by now I think are minimum conditions for the framework to be fixed, new lessons, and they will focus on resolution and recovery. So going back, the trauma of Lehman, it was a globally systemic cross-border bank, after all, that triggered the global financial crisis. It was definitely not the only cause, but it was the trigger. And the cost of the way that governments could react at the time, since they did not really have tools to deal with such a failure, was essentially two things. They did bailouts and they did ring fencing. And the bailout was enormous. Here are the numbers for state support provided in the US, UK, Euro area, and yes, also Switzerland. But the first three big areas each felt compelled to put on the table somewhere between 25% and 30% of GDP equivalent in guarantees and capital injections. Now, not all of that was used, not all of that was spent, But that is the size of what states' risk that they took. And it is not surprising that this had a very large outcry as a follow from that, and that both the economic but also the political and of course the regulatory fallout of that was very, very deep, very strong, and very prolonged. So never again is essentially what governments told and promised each other and themselves. No bank, no institution really, but no bank, let's focus on those, should be too big to fail. And what followed is 15 years of Basel reforms, and I did want to flash here. This is the skyline of Basel, which is very familiar to those who are either living there or go there very frequently. I happen to have been born there, so I always sort of, have a special relationship to all these Basel regulations. So let me say let me focus on two main reforms that happened over the last 15 years. One, there was a very laser focus on building capital, focus on capital. It had been, the global financial crisis was largely a crisis of solvency. So a large number of institutions failed because they were insolvent, so their equity was negative, at least calculated at the market prices of those assets, which were very hard to value at some stage. We're talking about the subprime and all its family derivatives. So it is equity stupid, if you want to have a tagline for that. So let's build equity. And the second thing, that relates to the way that this spilled across borders and the fact that the policy was essentially constrained to somehow deal with this in a very ad hoc manner, and in many cases the only way they could deal with it was to ring fence, essentially try to protect what is national and what the assets that they could grab nationally. But of course, that is not a very good system for the world, because it is a suboptimal outcome if everybody just grabs the piece that they can get hold of. So cross-border resolution, and another part of that here, the tagline was that in the course of Lehman, some supervisor is said to have said to the Americans, you keep your toxic assets, right? How do we deal with, how were these two things addressed? Well, on the one hand side, it was a lot about improving the quality and the quantity of capital buffers. Quality, because some of the equity that was in principle on the books was not really available when needed. It had been encumbered, and capital buffers as a whole had to be increased over many years as a consequence of these regulations. A second discussion at the time was whether it's better to, and this is a kind of an ongoing discussion, whether risk weighting or leverage ratio, how to measure capital ratios, equity ratios was a very live discussion. If you, prefer risk weights, because not all banks have the same have the same types of assets. If they have very low risky assets, then they may be able to hold less equity capital than if they have highly risky assets. The leverage ratio doesn't make a difference between those. All assets are valued equally, and you just have one number for all banks. The compromise here is basically both. We have both risk-weighted equity ratios and leverage ratios as that need to be fulfilled. And then there is the structuring of capital, which is, of course, familiar to people who are in the area, but may not have been familiar, it turns out, to the wider public, and I will get into that in a moment. When it comes to cross-border resolution, well, it was about planning, living wills, stress testing, Axel, who is sitting here, and at the time of UBS, we spent a lot of time with the living wills, recovery and resolution plans, which had to be constantly, reviewed, and also there were war games within the boards that needed to be, where the idea was, let's play out in theory what would happen in case of a, for instance, very large loss of through a cyber or another type of this event. So living will, stress testing, recovery and resolution. Multiple versus single point of entry, that is also something that is important in this context, because the question was, who is the resolution authority in the case of a globally active bank, which is in many places. I'll get back to that also. And finally, how do we coordinate between different authorities? And there the answer is there should be a lot of coordination, in particular when a bank becomes vulnerable. A crisis management committee is called, which is the supervisors of the main jurisdiction where the bank is active. So in the case of Credit Suisse, this was the US, UK, and Switzerland. Okay, so just a few graphs to illustrate that what was decided actually did happen. So these is European banks. Here you see the buildup of capital at European banks, both whether you measure total capital ratio, total loss absorbing capital, or whether you measure only core equity ratios, you have an increasing trend. And it's not only a denominator effect, because if you see on the left-hand side, where you have that in billions, that in fact capital in European banks increased from about 1 trillion to about 1.4 trillion, so quite a significant from 2015 to about now. So capital buffers were actually built up. At the same time, balance sheets were shrinking, and I'm using here, this is from the latest report that was issued on the lessons from Credit Suisse by the Swiss government, by the Swiss federal government. You see here that at the time when UBS failed, which is 2018, the total of UBS and Credit Suisse balance sheet was about 500% of GDP of Switzerland. It was even higher before. So those are the two combined, Credit Suisse and UBS. It has been over 15 years, constantly, both banks were reducing their balance sheet as a share of GDP, and GDP is not growing so fast in Switzerland, so don't worry, it's not the denominator, it's really also, again, it's the assets which are on balance, which are declining. And so today, you see the combined size of UBS and Credit Suisse as of today, they are still shrinking, but is something like 150% of GDP. So it looks actually small in comparison to the past, but of course it is large in comparison to most other countries. So now let me go to the structure of capital. This is the part where I will be spending quite a bit of time, because there is quite a bit of action in this area. So this is the way that ultimately, again, one could say this is a compromise that was struck. In the buildup of capital buffers, there are two types of loss-absorbing capital, which is the total loss-absorbing capital consists of equity, core equity, that's CET1. And then there is the AT1s, the famous AT1s, additional instruments that are additional tier 1 capital. They are bonds that convertible under certain circumstances. I'll get to those. But those two together, they should be absorbing losses in so-called going concern. So as long as the bank is viable, there is testified that it has a viable business model and it can cover all its obligations, you have a going concern. So those together are about 15%. These are the Swiss requirements. They're a little bit higher than the Basel requirements. And then you have, again, as much in so-called bail-in bonds, which are also loss-absorbing, but they become loss-absorbing after the point of non-viability has been called. And that is, at that stage, the supervisor essentially does the conversion from bonds into equity. So that is going concern capital. And again, there is both the RWA, the risk-weighted, and the leverage ratio, the leverage ratio requirements. So this is what it's supposed to, or what the idea was of what a failing bank would look like. So if it is going over time, you see it's a solvency crisis. So the idea is it's like at the time of the global financial crisis. The bank is losing capital, is losing equity capital. It starts out with an equity ratio, which is something like 14%. It goes down, down, down. And when it hits 7%, you see something happens. And what happens there is that the AT1s are automatically bailed in. And in the case of Switzerland, that would be the case that they were automatically written down. So you get the additional equity bump from the write-down of the AT1s. And this is while you're still in the process of turning around the ship. So if it turns around, then you have a successful recovery. If it doesn't, and the equity ratio starts falling again, so now we are in the blue. Not sure I can't point here, right? Now we are going down the light blue line, and at some stage, at the latest when it's 5%, the supervisor calls the point of non-viability, and at that stage, the rest of the total loss-absorbing capital is bailed in. And again, then the recovery and restructuring attempts to turn around the ship and keep the bank afloat. So this is the theory of how a recovery and resolution should be working out, and how it interplays with this capital structure of convertible instruments. So let me spoil it, and you probably know that's not what happened. It looked quite different in reality. But let me give you, this is the playbook on the too big to fail, the recovery and resolution, which is taken straight from the website of the supervisor. And again, if you come from the right-hand side, you have business as usual, then things get into problems, and there is the recovery phase, the AT1s, which are here called high trigger COCOs, because they have a high trigger of 7%, would be converted. If that fails, you get into the point of non-viability, and now comes a very important point. Now we are in the gone concern case, and what now should happen is the blue top resolution, namely the bail-in of the remaining total loss-absorbing capital. And if everything is going well, then from there you can go back into post-resolution and recovery. Only in the case where that fails, and that wouldn't be immediate, because let me already tell you, if that had happened, Credit Suisse would have had an equity ratio of some 40% on Monday morning. So it doesn't fail with 40%, at least not immediately. But only if that failed, then you would have gone into the red bottom, which is the restructuring, and that's called the Swiss emergency plan. At that stage, the Swiss entity essentially splits off the systemically important parts, and the rest is, wound down. It says here orderly wound down, but that would have been quite a difficult way to do this orderly. In fact, and this is why I am emphasizing it so much here, even in Switzerland, a lot of people, and I would think 80% of the journalists don't understand the difference. They think what would have happened is the red, that the alternative to the sale of Credit Suisse would have been the Swiss emergency plan. But so basically, the understanding that the actual big step that the whole too big to fail framework implies is the bail-in. That understanding is still not there. And there is also some confusion with words, because, apparently it seems to be, at least that's people are saying that when the American authorities at some stage were told, we may have to go for bankruptcy, they also thought, bankruptcy relates to not bail-in resolution, but to liquidation, and so words and terms, unfortunately, sometimes also matter. They also translate very badly into German, by the way. So single point of entry, essentially that just means that, and this is the strategy that almost all GSIBs adopted, is that there is the home authority, which is the resolution authority, and it triggers the bail-in from the top entity. Rather than, and that would be the alternative, that you have a multiple entry strategy where a lot of the host authorities, say for instance the American and the UK, they each have intervene at their local level of their subsidiaries. This is the strategy that was adopted by some retail banks, global retail banks, because for them it's appropriate, but essentially all other global banks have a single point of entry where the home authority, i.e. the Swiss supervisor, is the resolution authority with bail-in capacity for the world, right? Together it has to coordinate with the others, but it is the one that assigns. Okay, so we come to what happened. The first real-life test of this framework. Here, this is the picture that I would think rather shocked Swiss and probably also, beyond Switzerland's borders. On the evening of March 19, Sunday evening, this is the picture of the Federal Council, the president of the Federal Council, the Swiss central bank governor, and the president of the supervisor. And on the left-hand side, you have the chairman of UBS, and further to the left, but he's already being cut off, was the chairman of Credit Suisse. So they are sitting there and announcing that the following deal had been reached. So UBS buys the shares of Credit Suisse for $3 billion for the total shares. This is, just to put it in perspective, about a 90%, depending on where you want to start it, but it's about a 90% loss for shareholders, so not a walk in the park for shareholders. It also bails in 16 billion of AT1s. Again, I come back to those. And at the same time, there is a public liquidity backstop, which required emergency law because it was not part of the institutional setup of Switzerland. The public liquidity backstop of 100 billion is for the Swiss National Bank to be able to provide funding and liquidity in resolution. So this is not for UBS, or indirectly for UBS, this is for the Swiss National Bank that required this in order to be able to provide liquidity, even though the appropriate collateral would not be available. And then there is a second loss piece, which is a guarantee for hard-to-value assets that the government took after UBS takes the first loss piece. So this piece here, this is what caused and keeps causing in Switzerland a lot of, outrage, because there is public support here, in particular through the loss guarantee, and that was kind of promised that would never happen again. So the Swiss political fallout is still ongoing, partly due to this fact that there is this bailout element, but do look at, if you look at it, the shareholders definitely did get to pay a lot, and AT1 holders lost everything. The other ones who in this type of deal were lucky were the holders of bail-in debt, right? They would have been next in line, and they were made in full. In fact, that paper went up. Note also that it was actually needed. This liquidity was needed. The Swiss National Bank had to provide up to 170 billion. Swiss GDP is about 800 billion. Yeah, so just to put it into perspective, Swiss National Bank is huge. It has huge assets. It did not have trouble to procure this liquidity, including in US dollars, because most of it was needed in US dollars, not in Swiss francs. So there is clear lessons around this for central banks, for those providing and establishing institutions that can provide sufficient funding in liquidity and funding in resolution. And all of that had not been in place. It had been under discussion, by the way, the public liquidity backstop. Now it is being put into law in Switzerland, because this is one of the clearest lessons from from Credit Suisse. You need funding in resolution. And let me also say so, because this may not be familiar to you, but in Europe, this is not in place. In the euro area, there is not a sufficient mechanism like a public liquidity backstop that would be able to do this for a GSIP in the euro area. So was the picture I showed you before, did this happen at Credit Suisse? You know, was it losing capital? Answer, no. I showed you, and again, I wish I could point. If you look at the last column, there you have the minimum requirements, 10% for core equity, 14% if you include AT1s, almost 30% total loss absorbing capital. How much did Credit Suisse have? On risk-weighted assets of about 250 billion, it had almost 100 billion of total loss-absorbing capital. Those are the 40% I was talking about. You know? If they had actually done the full bail-in, you would have had a equity ratio on impact on Monday morning of about 40%. But notice that everything was way above the minimum requirements, moreover, as quite stable, no? Because, you know, there had been a first run on Credit Suisse at the end of 22. So if you are looking at this, you did not see any problems. And the same is true for the leverage ratio, very stable and very much above the minimum requirements. This is the picture you'd have to look at in order to see that there is trouble. On the one hand side, you see here that both the share price and the price to book ratio were constantly falling with small reversals. And the yellow line is the Stoxx 600 banks index. So you see that Credit Suisse was really different. It was not something that was happening at other banks or on average at other banks. And what some of these bubbles there are some of the big news. It was constantly in the news and always in a bad way. These are the profit warnings. These are the restructurings. This is the green seal and the Archegos large losses. And so when you look at this picture, then you say, okay, you know, this is clearly something is wrong in this, something is smelly here in this bank. I have a same picture again from the Federal Council report, simply because it goes back a little bit further in time. So this one starts in 2015 when Tidjane Thiam was appointed new CEO, and you see that if you look at it this way, it's an even longer decline in the share price, at least. But notice also interesting, you know, the CDS reacts very late. So for the longest time, this was not seen as a problem of a possible total failure, but really just a problem of the business model and the valuation of the company. So the franchise model, the business model. Okay, now we have an even bigger one. The business model here is, and another way of putting this, markets, investors, and eventually also clients are losing trust. You see in March the first one, those were the wealthy clients in Asia, prompted by a tweet that ran in October of 22. That then calmed down. Where is it? Well, in this big picture, I think this one here, you could see it better. Yeah, it's this last, fall there. That's the first one. And then by the time we reach March, you have the absolutely not of the major shareholder who says, no, he would absolutely not invest further. And then you have the SVB and general nervosity about new waves of banking crisis in the US. And then eventually you have also the retail clients in Switzerland running, so that it becomes a full-scale run. When people talk about risk management being a problem, it always sounds very abstract. So I thought I would bring one very concrete example without saying that this is, the cause or anything of the demise of Credit Suisse, but it is taken as an excerpt from a special board committee report that the board commissioned 2021 after the loss of Archegos, where Credit Suisse was in fact the one with the largest loss of all. And essentially, you know, long quotes that I'm not going to read, but essentially what they're stating here is that the US-based co-head thought that he was not responsible for Archegos, and neither did the other co-head who was in the UK, right? So neither of them was responsible for Archegos in their own mind. Indeed, neither claimed any particular familiarity with Archegos, including its persistent limit breaches before the default. So, by the way, I thought also that this is an interesting quote because there is something about COVID. I was always a bit concerned that during COVID things may happen, that everybody is at home and all traders are at home, and whether this is really whether you can really produce business as usual under those circumstances. Remarkably little actually happened in the end, but this is one example where probably COVID did not help. When you have, you know, unclear responsibilities, changing people and reorganizations, and everybody is home. So what did happen? What did the chart look like? So the recovery options did not work. I will get back to that. The AT1s were bailed in, but just before the point of non-viability, and the point of non-viability was not activated because there was a sale instead. So the bail-in of the rest of the bonds did not happen. So one way to visualize this is that, you know, capital did not sound the alarm bell. Capital was, equity ratios were at 14%. I showed you all the other ratios also. By the way, liquidity also was way above the requirements, while the share price is falling constantly. And then there is the 81 bail-in, which becomes part of the way that the option that they realized in order to make this sale possible. Now, after this happened, there was a suggestion, and the Financial Times actually put the finance minister of Switzerland on the first page and saying, oh, the framework doesn't work. So that this was, you know, said in Bern and went down very, very badly in Basel, because it's like, hey, what? You mess up and now you say the framework doesn't work? You should have just done the bail-in. That would have been the framework, the full bail-in. That was the reaction. So the question was, why was the bail-in not done? Why was the point of non-viability not called? So several possibilities. Number one, and this is what the authorities are saying, well, we had a less risky option. Yeah? And it's true. It was less risky. I mean, financial stability was safeguarded not only in Switzerland, but across the world. There was a 1 week of some turbulence, but that also calmed down quite quickly. So by doing this deal, the authorities, and you know, many have come back to them and have said, thank you so much and congratulations for doing this. They had another option. Okay, well done. And by the way, in this expert group that I was a member of, we fully agree with this assessment. The outcome was they did the right thing, but it was not such a clever thing to suggest that there was no alternative and that the too big to fail framework as whole was broken. But let's look into that next. One of the lessons that comes out of that, and this at least in Europe is already being debated, is that this very rigid resolution framework that I showed you, where essentially you only have a bail-in, open bank bail-in over a weekend as an option, may not be optimal. So you may want to have more options for doing such a resolution. You may want to have more time. You may want to have more competitors if the question is about selling parts. then open bank bail-in over a weekend is not such an optimal strategy, and bridge banks, as they are known in the US, might be a better idea, or at least an alternative idea. So this is one of the things that are being considered in terms of changing the resolution playbook. But then there are also more, let me say, technical or necessary conditions in order to make the bail-in work. And they were not in place. Yeah? So the funding and resolution I've already exposed at length, that was necessary, that needs to be there. And if you don't have it, if you don't have a way of putting in place sufficient liquidity in resolution, then it's a problem. A second thing that is a bit more technical, but also is a big question raises questions for the bail-in resolution, is the question of whether all jurisdictions, all big jurisdictions, would have actually accepted the bail-in automatically and immediately. Now, remember, they've all signed on that dotted line. So the US was part of the crisis committee. In fact, the SEC was invited to become part of the crisis committee eventually, because the SEC turned out to be an obstacle to the bail-in, because according to their own rules, they first have to either grant an exemption or have to test and do a registration, which takes about 6 months. And of course, can you imagine that you did the bail-in, and on Monday morning you said, okay, here is another 50 billion that needs to be converted into equity, and then the SEC says, wait a minute, we first have to look at this. That would have been really chaos. So more generally, then, it's not only an SEC problem. The question there is the bail-in has to be also accepted de facto. There have to be a procedure to get comfort ex ante that if a bail-in happens by the single point of entry authority, that there is going to be an automatic acceptance of this conversion in all jurisdictions. Then, this is, the bail-in, I have already underscored this, but it really gets me. Outside this tower here, this is the BIS tower, where all these regulators and supervisors meet. The bail-in resolution is just very, very poorly understood. And that's true in Switzerland, but it is clearly also true across borders. It's also true that a lot of investors who were holding AT1s did not know what they were holding. I'll get to that in a moment. So let's move forward. First, need to fix the end game. That was the first thing that needs to be credible, and for that, a few things need to be fixed. But better, of course, you don't get to the end game. So the question is, why did the recovery options not work? How can we fix the recovery game? And here are a few reasons why the recovery may not have worked. Well, maybe it was just bad luck, as probably partly Credit Suisse management would say, that too many things were accumulating, but partly it may also be at some stage that there is a collusion in a certain sense between the supervisor and management in resisting to be too public about large things, about large actions that could trigger, in fact, a run, or tell markets, oh my God, this is worse than I thought. So if all of the above, then let me skip this one because I already got the warning, and just talk about AT1s. I know those were in Asia of particular concern. The AT1s I showed, they are supposed to be going concern capital. So they're perpetual in principle. Interest and repayments are at the discretion of management, but in practice, and they're only sold to very large investors in principle, in practice, they are not. So the market has sort of an expectation that they are called at the earliest date, and that interest is paid even when, even in difficult times. So especially then, because you then don't want to signal that you actually cannot or would not like to pay this interest. So Credit Suisse issued it called in June 22, AT1s for 1.6, I think, billion. I think it's coming next. And and with a coupon, and issued new ones with a coupon of almost 10%. So, I mean, that is highly procyclical, right? You don't want to, if you're already under pressure, you don't want to be refinancing at the rates, at those rates. That is not the idea of AT1s. The AT1s are supposed to refinance you, not to make things more difficult. Now, here comes the second trigger. I showed you the AT1s have a trigger of 7%, which is automatic, but the Swiss AT1s actually have a second trigger, and that is absolutely in line with the idea that they are going concern, namely that they can be written off by the supervisor in a second circumstance, namely a viability event. And before I show you the language, this is straight copy-paste from the prospectus of Credit Suisse of this last AT1 issue. And, I'm not a lawyer, but I can read. And it is absolutely incredible. It is absolutely plain English. It says there, these are write-down instruments. It's 0-1. It doesn't convert into equity, and it converts into 0 under these two circumstances, either 7%, or this is the viability event. Now it's hidden behind the chairs for you. It's when there is a commitment, irrevocable commitment of extraordinary support from the public sector. That's the second. That's the viability event under which the supervisor wrote down the AT1s, because that was obviously what had happened. So there is a problem with these AT1s. They're poorly understood. Investors didn't know what was happening. It was a surprise. But if you read the prospectus, it should not have been a surprise. Last point. How do we move the recovery regime forward? Improving the probability of early intervention. This is what it's all about. So rather than getting all the way to the point of non-viability, can we have, and this is the proposal here, a recovery regime which is activated automatically? And why would you want automatic activation? Well, because if you don't, you may end up as an equilibrium with too little too late. If faced you go down here, faced in a vulnerable situation, faced with the possibility that by doing something large, AT1 recapitalization, sale of significant franchises, change of management, you may fear, and the supervisor may fear, to be sending a very negative market signal, triggering a run, and then going into resolution. But on the other hand, if this fear is too large, then don't rock the boat, reassure markets, and do only talk behind closed doors and with management, maybe leading to too little too late. And by the way, this structure of the game is not unique to this situation. We know this very well also from international finance, from the IMF and its travels with countries that should go into debt restructuring and do too little too late. So here we have a bad equilibrium of the intervention not taking place, at least not sufficiently early. How to fix that? Well, rather than going up that route, having the supervisor essentially binding the hands of the supervisor to a special recovery regime, which would be activated under certain circumstances, to be discussed which ones they are, and maybe that already will stabilize the situation. If it doesn't, then the supervisor, if outflows do actually increase, the supervisor may have to have also instruments to curb outflows. But the point would be, you shift from a situation where you end up with resolution in the bad equilibrium to a good equilibrium by credibly, essentially, taking away the legal uncertainty of the supervisor's hands are tied to this recovery regime. So the absolutely key question then becomes, and we had a long discussion in Basel about this, like 10 days ago, is if you like this, well, a lot of people just, of course, don't like it because, hey, do you want to have rules-based activations here? And what is the right rule is the first question. If you bind your hands to the wrong mast, is that worse than if having discretion leads you to do too little too late? But, I would argue that one of the lessons is, in fact, this. When supervisors are confronted with very, very large it's a very high stakes game. So it has to be, it can only be solved by moving everything significantly forward. It turns out that in the US, both in the US and the EU, there are already similar regimes to this. One is called prompt corrective action. It's very old. It's from 1991 in the US, and it has capital triggers. So when certain capital triggers are reached, then the US supervisor has to intervene. It's mandatory. There is no choice. It's completely rules-based. Now, trouble is, of course, I showed you, capital would not have triggered here. Credit Suisse died as a highly capitalized institution. So the European, this is an early intervention mechanism, is called from 2014. It's part of the so-called BRRD, the Recovery Resolution Directive. It has more triggers, so it has supervisory ratings, it has material changes, or even significant events can be included into the rules that would then activate this kind of special and heightened interventionary powers. Now, obviously, we have one of the classical problems here of rules versus discretion, right? You would like to have a well-defined set and a narrowly defined rule in order to make the regime credible, in order to tell the supervisor, here, now you have no choice, now you need to intervene. And of course, when this is well known, then of course also the institutions that are facing this will know that this is happening, and this changes this should change the behavior beforehand. You want to stay away from that point of intervention. So defining that intervention point, defining how much rule versus discretion can be applied here, I would suggest now that probably you want a rule, you want to make it mandatory, but then the supervisor, if it does not, for some reason it says, okay, we've had all these triggers, but in this circumstance we don't think this is valid, then the supervisor has to explain why, and probably publicly explain why it's not being activated. So that's it. I hopefully have convinced you of that there are at least two very important lessons to be learned. We need to make resolution credible. There are a number of things that need to be in place for a GSIP to be resolved across borders. And all of those four, in my opinion, are maybe not of equal importance, but all necessary conditions for this to be a viable solution. And last but not least, or more importantly, and that's where my thinking is much more these days, shouldn't we have a special recovery regime which has mandatory activation and therefore reduces the bias of management to essentially hope and wait and hope, and of the supervisor also to collude ultimately in waiting and hoping and only doing things behind the scenes. Making this, of course, there's no question, making this public will move the whole game forward. And there are legitimate questions you can have about what the type of triggers should be, but yeah, I come down on, I'd rather have more rules than discretion in this area. Thank you.
Thank you very much for the insightful remarks, Professor Weder di Mauro. May I please ask that you take a seat at the sofa area on stage. Could we invite Professor Steve Davis back on stage for the discussion and Q&A portion of the policy note session, please?
Thank you, Beatrice. That was a wonderful presentation, and I also want to say that the underlying paper is a extremely lucid, compact explanation and discussion of a very complex set of events, so I highly recommend the paper as well. I learned a lot from the paper and from your presentation. The thing that most surprised me about what I learned, and this is what I want to ask you about first, is what looks to me like a foreseeable major flaw in the architecture that was anticipated to deal with these globally systemically important bank failures. So let me elaborate on that and draw on what you said. So as you pointed out, there was the going concern, AT1, equity that could be called upon or capital buffer that could be called upon. But then at the point of resolution, you had these bail-in bonds, or the point of non-viability, I guess was the term you used, these resolution bonds. And what I learned from your paper and again from your remarks here is that there was no mechanism in place to compel the implementation of the bail-in bonds across borders. And that's just, I was stunned by that, because it means that the architecture was in some sense a house of cards, at least if you got to that end game. There was no credible end game. You clearly don't want to play a game of chicken with supervisory authorities across the world when a major systemically important bank is, on the ropes, as Credit Suisse was. So I'm thinking to myself, there are thousands, maybe tens of thousands of person hours that went into the design of this system. It was in response to this call by people around the world that we don't want to bail out the banks again. And yet what ended up happening is Swiss taxpayers, at least, were on the hook for the resolution of the assisted purchase of Credit Suisse. Now, the reason I say this was a foreseeable problem is, first, there's the obvious reason. You just can't compel. You used the example of the SEC, but I think it applied more broadly. But also, if you think for a second, you can see that the incentives are, well, the SEC, if there's no advance agreement to compel it to cooperate, who is it going to act on behalf of? Presumably the U.S. government and U.S. taxpayers and U.S. bail-in bond holders. So there's a natural source of tension. You don't want to get to that point. So I'm asking myself, was this not foreseen? Was this problem not foreseen? And if not, how could it have not been foreseen? It seems like an obvious problem.
If you read the FSB reports, it's not like it was not foreseen. It's always there, that always is sometimes, it's easier to read these reports after the fact. It's like, okay, when they talk about legal uncertainty, that's what they mean. Huh? So it was not foreseen, but and let me also say that in the case of Credit Suisse, they had it under control. They think that, they being the crisis management committee that had been meeting for months, and they had included the SEC for that reason. So the conviction actually of all the people we talked to in these hearings is that they could have done the bail-in and that the SEC would have granted the exemption, but the SEC refuses to, and we had a very enlightening talk with the lawyer, the general counsel of the SEC. That says, in their mandate, they are not allowed to give comfort ex ante in written. They may say, that's. But that's what you need, right? You need an agreement with everybody and all the authorities. Now, your question is absolutely right, because the US and the US supervisors, regulators are all on board with a single point of entry bail-in. They helped build the system, but it wasn't the SEC. So you see, the point is that part of the problem is that when there are too many authorities and they may have mandates, maybe partly competing, conflicting mandates, they all need to be brought on board. And but on the other hand, this is what the FSB and Basel is supposed to do. So in my view, this is a problem that will be solved because now it's obvious, right?
Yes, okay, so in short, as I understand your answer, it just wasn't thought through in advance, despite the enormous amount of attention that went into building this architecture.
When you have too many regulatory agencies, in the US alone, how many do you have that are all somehow part of the story, and that's only the US, right?
No, I understand that. So there's a coordination problem, but there should have been stress testing of the architecture and how the regulators will respond, not just stress testing of the banks. Because this still strikes me as an obvious problem ex ante. It's obviously easier to think about these things in hindsight. I had the same reaction when you understand, well, how did Silicon Valley Bank fail? It was like duration risk 101. And it seems like such an obvious problem for a bank and for the supervisors. So blunders happen in this setting, and I'm arguing that this was a blunder in the form of the architecture. The blunders now become clear, as you explained, as a consequence of the Credit Suisse episode. But it does seem to me like a blunder, and it undermines my confidence somewhat in the overall. There may be other hidden blunders in the global regulatory system that haven't yet been revealed.
I mean, look, it's actually quite ironic if you think that the SEC may have, if that had happened, what I said, there's a bail-in and the SEC kind of blocks it, it would not have been acting, of course, in the interest of the bail-in bond holders of the US. If a financial crisis happens, that's kind of the worst for everybody,
fair
right?
Fair enough.
So it's not,
yes.
it really, I think it's really a coordination issue.
Yeah.
Because there is a common interest in having sufficient legal certainty around this building. Or put it differently, we've built this huge architecture. It better work because that's the one that we have right now. I always say, when people say, oh, we should have instead just gone for 30% equity ratios, and I said, yeah, sure. If 15 years ago we would not have climbed this mountain, but rather another one, that might also have been a possibility. But now we're standing on the top of this one. We have to be able to operate and climb it up and down. That's the one that is built there. Yeah.
Right. So you also, you also point out other problems, but the other ones seem like more familiar problems. The fact that institutional investors didn't fully understand the risks they were taking on with the AT1 buffers. I mean, I think back to the global financial crisis. It became evident in the fallout from that many investors didn't understand the risks that were inherent in the mortgage-backed securities they were holding and so on. So that seems like more of a perennial problem. Your solutions are to more clearly educate the regulators, but also the investors about the risks. Fully on board with that. But that's always the case. No matter what we do, we'll have to undertake that education effort.
Yes, but it's another thing that is so easily said. I mean, to make it more, I live this every day. It's 1 year after Credit Suisse failed, and still today there is so much confusion about the too big to fail framework. And that is the basis on which then policies are made. I mean, in Switzerland, the political fallout is still ongoing, but when people don't understand the difference between disorderly bankruptcy and bail-in, then we are kind of really talking in different languages. So it is much more than just educate and so on. It really, if this is supposed to work, then everybody has to know what it is that is supposed to work. And let me tell you, it's not only the uninformed journalists. It's also supervisors in other countries that didn't understand this. Those who were not in the crisis committee. The Europeans were not, did you notice, in the crisis committee, because Credit Suisse is not large enough in that jurisdiction. But the Europeans are, of course, highly, highly concerned about what's going on. And their first reaction was to issue a statement that this with the 81 thing would never happen in Europe. It's true, because they have a different design. But it was maybe helpful to calm down the market in that moment, but it was not helpful for the framework, because in principle, 81s are supposed to have this function of recapitalizing and growing concern.
Yeah, that's a striking point too, and I guess it illustrates economists are often capable of designing something that works in theory, but are a little bit less good on the follow-through with the execution. And you're saying part of the execution failure here was a lack of communication among the various regulators about what was actually entailed in this architecture.
I mean, in Hong Kong and Singapore, there are many places that were not part of the crisis committee and where the information probably reached relatively late. I mean, I know for Hong Kong, I know, but at the time they were already had the solution with UBS and knew that it was not going to be a Lehman. But there were countries in which my understanding is they were preparing ring fencing in case it would be a Lehman kind. Mm-hmm.